Well, good afternoon, everybody. My name is Lee Schwartz, and I'd like to welcome you to today's webinar. This webinar is titled The One Big Beautiful Bill Impacts, What Every Nonprofit Leader Needs to Know. So we have an obscene amount of ground to cover today. So just real quick, I want to say a couple words about SVA. You might remember back in 2017, we tried to educate our clients and the nonprofit community on the Tax Cuts and Jobs Act. And then, of course, 2020 came, and we all know what that brought along. But we were really the leaders in making sure that nonprofits and everyone out in the marketplace knew about PPP and ERC and the CARES Act and all the different aspects that came along with the pandemic. And now here we are with the One Big Beautiful Bill Act, or OBBBA, as we're calling it to save time. But here we are, and we're out in front again. Obviously, we have this webinar, but keep in mind, we are producing a lot of content to help you. And if you go to sva.com/OBBBA, so that's 3 B's, so sva.com/OBBBA, you'll see additional information like biz tips, upcoming webinars that we might have scheduled. And we do a weekly podcast called The Biz Beat by SVA, where we talk for 15 to 20 minutes each week about different aspects of the bill and other things happening out in the marketplace. Feedback so far has been that the content is really, really good, but that one of the hosts is super annoying. And I will give you a hint who that might be based on my microphone. But as far as this webinar goes, please send in any questions you have as we go, but we are going to wait till the end to answer them. If your question doesn't end up getting answered, feel free to reach out to me, and I will make sure one of our subject matter experts gets that question answered. So before I introduce our SVA presenters, though, I would like to bring in Mary Salisbury of AFP to say a few words. Mary, are you there?
I sure am. Thank you so much, Lee. Good afternoon, everyone. My name is Mary Salisbury, and in my day job, I serve as the Director of Philanthropy for Girls on the Run, South Central Wisconsin. If you don't know, Girls on the Run is an after-school program, and we are on a mission to help 3rd through 8th grade girls find joy, health, and confidence through running. In addition to Girls on the Run, I also have the privilege of serving as the president-elect for AFP Greater Madison. And for those of you who may be new to AFP, AFP is the Association of Fundraising Professionals. And it's a global community of development professionals and nonprofit leaders, folks committed to advancing ethical fundraising practices and really strengthening the impact of nonprofits. Here in Greater Madison, our local AFP chapter is a great way to connect with peers, gain that peer support, share ideas, and just connect with others who understand the work. If you're not already a member, I want to invite you to contact us or contact me anytime. We'd love for you to reach out and to learn more and to have you join us. So on behalf today of AFP Greater Madison's board and our members, thank you for joining today's webinar. We are just so privileged to partner with SVA. As nonprofit professionals, we know how critical it is to understand these policies and this legislation that's shaping our communities and our sector. So today's session, I know, is going to help prepare us to lead with more confidence. So a special thank you to our presenters and again for SVA for sharing their expertise. We're so grateful for your leadership in this space. And thank you to all of you who are joining today for investing your time to strengthen your missions and again, the communities that we serve. Lee, back to you.
Awesome. Thank you, Mary. And right back at you. We appreciate the partnership as well. And you guys have a great organization. So the fact that we could do this together, I think, was a great fit for both our organizations. So real quick, let me introduce our 2 presenters because they got a lot of stuff to talk about. Our first will be Kirsten Houghton. Kirsten is a principal here at SVA and is the leader of our nonprofit industry group. Many of you know Kirsten. Following her, and they'll be going back and forth a little bit, but we'll also have Holly Eisenhower. Holly is also a principal here at SVA and is the leader of our tax service line. So a very, very busy person right now. But without further ado, I will see you guys at the end for Q&A. But Kirsten, I'm going to kick it off to you to get started.
All right, thank you, Lee. Hi, everybody. My name is Kirsten Houghton. I'm a principal at SVA and the leader of our nonprofit services group. And thank you for joining us today. We really appreciate the really enthusiastic attendance as far as numbers. There's a lot going on and a lot to understand. And my section is more on the second half of the presentation, but just in general, we're going to talk about understanding the impact of HR1, or also the big, beautiful bill, on the charitable sector. There's a lot of activity and impacts in the nonprofit sector, everybody, but there's a lot of positives and negatives, I guess I'd say, or challenges also. But there's sweeping tax reforms, there's entitlement changes and spending realignments. And when the bill was celebrated in some circles for its charitable giving pieces, the incentives and economic deregulation, the full impact on the nonprofit sector is complex, and some of it is very transitory. We're not sure what's going to happen when you think about federal funding cuts or federal freezes, things like that, but I will talk about that later. There will be opportunities and there will be challenges. So it's impacting our local communities. We already have some clients that have been impacted, and I'm sure some of you in the audience have been as well. But right now I'm going to turn it over to Holly. So Holly's going to work through some individual tax information because we thought it would be a good fit to go with the charitable deduction piece so that you could understand as individuals more of the tax implications and then also how it's affecting your donors and then tying that all together. So Holly, I'm going to turn it over to you.
All right, thank you, Kirsten.
Sure.
Great to be here and happy to be sharing all of this information with you all. So we're going to start out with some individual taxes and discuss some of these individual tax provisions through the lens of your donors. Right, we have left some of these provisions in the presentation that may not be 100% relevant to today's discussion, but wanted to leave them in there because this is impacting you as much as it's impacting your donors. So just for some reference material for later. But we want to start out by just talking about what's changing and what's not. Overall, OBBBA, our new tax law, is much more like an extension of the Tax Cuts and Jobs Act, which is our current tax law, than what it would have reverted back to had we gone back to the pre-2018 tax law. So when we're looking at what's changing and what's not, overall, there's a lot of changes that are going to be really pro-taxpayer. We're going to see the extension of these lower tax brackets, right? So we've currently had very low tax brackets the last 7-8 years with the 10%, 12%, 22, 24, 32, 35 and 37% tax brackets. So those have all been made permanent. And so we'll continue to enjoy those lower tax brackets, which generally is encouraging people to accelerate income and fill up those lower tax brackets. But while those tax brackets are permanent, in the tax world, that's a little bit of a relative word. So when I think about it, like, well, they're at least permanent for this presidential term. We'll see what happens in 4 years, but for now it's permanent. So we also have changes in the standard deduction and personal exemptions. And with the Tax Cuts and Jobs Act that started in 2018, we saw that standard deduction really be enhanced and really go up. And so many taxpayers and like donors, right, they are taking that standard deduction instead of as many people itemizing. So created some simplicity, allowed people to have a higher deduction. But with that, they weren't getting a deduction for those small charitable contributions that they may have been making. So we'll talk more about that. And then the personal exemptions, really with that increased standard deduction, the personal exemptions went away and they have become permanently terminated. So on this next slide, not going to spend too much time here. A couple of different changes with the child tax credit and the dependent care or the dependent credit. But then alternative minimum tax used to be something with taxpayers, donors that they might get subject to depending on what their itemized deductions are. Thankfully, within OBBBA, those phase outs have continued to be enhanced. And so not expecting too many people to be subject to alternative minimum tax at going forward either. The estate and gift tax exemption, may have heard about this, but there's lots of chatter over the last year just of whether it was going to get extended or not. So it had been at about 14 million per person and was set to sunset at the end of 2025 and go back to about half, about 7 million. And so there was lots of people looking at their estate plans and potentially seeing like, hey, should I be gifting more now so that I can get out of potentially paying an estate tax when I pass away? That has been now made permanent at 15 million and will be indexed for inflation. So that changes the conversation a little bit, but it's still important for people to be doing that estate planning and know where their money's going to go. So moving on to the state and local tax cap. So this is a $10,000 cap that's currently been in place and would encompass your real estate taxes, your state and local taxes, and charitable contributions, essentially the state and local tax. So real estate taxes and state and local tax. So it's currently been at 10,000. So starting already in 2025, that threshold has been increased for certain taxpayers to 40,000. So with that, we might see actually more people itemizing because if their real estate taxes are high or their state income taxes are high, the ability for them to have their itemized deductions be higher than their standard deductions might happen a lot more often. So, right, if we have our standard deduction kind of here in the middle and our itemized deductions are what changes. So when Congress added in the higher standard deduction, so this moved this like kind of gimme deduction to everybody and made it much higher, people didn't need to itemize as much or collect that information. All right, so now with the SALT cap being increased to 40,000 potentially, then if their standard deduction is 30,000, but now just with state and local taxes, they might be able to get a $40,000 deduction. Now, any of that charitable donations that they give, they now might be able to get a dollar for dollar tax benefit on those, where when the limitation was at 10,000, they would have had to give a lot more to charity before they saw that dollar for dollar tax benefit. So this does phase out at folks over 500,000 of modified AGI, but just think of that as your total income. So there's quite a few people, those modest donors that are going to be under $500,000 of income. And so we just, again, might see more people itemizing, which could benefit just as you're thinking about how to communicate with your donors, right? Just add some more tax benefit to those dollars that they might already be planning to give, or maybe now that, hey, I might get a benefit, they might start giving more. All right, moving on, we've got a slide in here, a couple items that don't really relate to our discussion today, but I left them in there just in case you're looking later. So now we'll talk about some more charitable contribution items. So I'm going to talk a lot about charitable contributions, just because this is going to impact obviously you, but also your donors and the organizations that you serve. So with this new OBBBA, the new tax law, we have this concept of a universal charitable deduction, which isn't completely a new concept. If you remember back in 2020, COVID, they had introduced a smaller version of this. It was like $300 per individual of a charitable deduction that you could get even if you took the standard deduction. So they've now reintroduced this concept and made it permanent, where now if you take the standard deduction, you can take a charitable deduction on top of that up to $1,000 for an individual taxpayer or $2,000 for a married couple. So again, for those modest donors that maybe are going to give anyway, now they can get a tax benefit for that. Or for people that maybe might be new to charitable giving, right? They're going to see that as like, hey, this is an opportunity where I can give to charity, but also save a little bit in taxes. So then we also have a change for those that take the that do itemize, and starting in 2026, so not starting this year, but starting next year, there's going to be a 0.5% haircut on charitable contributions. So this is similar to how medical expenses work, where there's a floor, and that first 0.5% of your charitable contributions are not going to be able to be used as an itemized deduction on your tax return. That 0.5% then gets carried forward and potentially could be used in the future. But that's going to just potentially discourage some folks from giving as much, or at minimum, it's just going to give them a smaller tax benefit for those donations. So let's talk a little bit about different charitable contribution strategies. And many of you on this call are probably aware of these different strategies, but just in case, thought it'd be good for us all to talk about them together. So with this increased standard deduction, the concept of bunching is going to continue to be in play. And so bunching is where a donor or taxpayer might decide that I'm going to do 3 years worth of donations and do it all in year 1 so that I can, remember the standard deduction is here and our itemized deductions move. So I'm going to do 3 years of charitable deductions so that I can get over that standard deduction threshold in year 1. And then in year 2, I'm going to have minimal charitable contributions. And so then I'll maximize my benefit of the standard deduction. So many folks use this as a strategy to save some additional taxes in year 1. And with bunching, typically all of those funds are going to the charities right away. So some folks are happy with that. Other folks are like, I really don't want to give it all to charity in that year 1. I'd like to spread it out, which helps organizations budget, or maybe they don't know where they want to give those charitable dollars to. And so then we move into the middle bucket there, the donor advised fund becomes an option. And so with this donor advised fund, you can do the same thing where you're taking 2-3 years worth of charitable contributions and you put it into essentially a brokerage account. So it can be with Schwab or Fidelity or the like, and you put it into this charitable account, and then over time you can grant charities money from that account. So a distribution out of a donor advised fund is called a grant. And so you can put, let's say, $100,000 in year 1, and then over the next 5-10 years, let's say 10 years, you could take $10,000 out of that account and donate to a charity. So it allows you to spread that money and decide later where you want it to go. So those are going to continue to be a tool that's used for donating to charity. And then the last bucket is for those that are generally retired, those that are over at least 70 and a half. At 70 and a half, you're able to take money out of your IRA, your individual retirement account, and make distributions directly to charities. And we call that a qualified charitable distribution, or a QCD. So at 70 and a half, you're able to do that. It's not generally until 73 now when people have a required minimum distribution out of their IRA that we really see this strategy used a lot. Because at that point, when they're 73, there's an amount of money that taxpayers have to take out of those IRAs. So then it becomes income on their tax return. And by doing a QCD, you can just kind of wipe out that income and get it to charity. And then it doesn't impact your standard deduction or your Schedule A. So it does several things. It reduces your income. So if there's any tax laws that are based on what your income is, it can help you stay below those thresholds. And you don't have to worry about if I take the standard deduction or the itemized deduction. And with some of the new haircuts that we're going to see in the charitable contributions, you can avoid those as well. So every dollar is going to be a tax benefit if you use that qualified charitable distribution. Again, it's only going to be for a certain population of our donors, right? Because they have to be at least 70.5, or more often it's going to be over 73 when we're doing that. So lots of different strategies that people use for donating to charity. And I guess one other thing that I wanted to mention that's not changing is the um, thresholds for different types of contributions. So straightforward contribution is take cash, I can write a check, or I can go online and contribute to a charity. So those cash contributions, you can potentially get a deduction for up to 60% of your income as an itemized deduction. So that hasn't changed. So cash contributions still very beneficial. You can give away a lot of money in 1 year and get that current year benefit. Another thing that we see a lot is the appreciated securities, right? So we have somebody that maybe they inherited some stock when they were a child, or for whatever reason, they have stock in their portfolio with pretty low tax basis. And for them to donate to charity, maybe they would have to sell that stock and pay capital gain tax on what the difference between the fair market value of that stock and what their stock basis is. Well, instead, maybe they just contribute that security directly to the charity. The donor, the taxpayer, they get the benefit of taking a charitable contribution for the fair market value of that donation, and the charity doesn't have to pay any taxes, and so it's kind of a win-win for depending on the circumstances. Okay, moving on, we've got one more tax change that I want to discuss with you. And back in the old tax law, it was called the P's limitation. For the past 7-8 years, we haven't had that concept in our tax law. It was suspended, and it's essentially been permanently suspended in OBBBA. However, they've added a new cap. And so the new cap is for those highest income taxpayers. So those that are in the 37% bracket, which is our top tax bracket right now, they might get a haircut on all of their itemized deductions, which would include charitable contributions. And so the limit is either you get 2/37 of the amount of itemized deductions, or your taxable income exceeding that 37% bracket. In other words, the max deduction on your itemized deductions is limited to 35%. So if you're a taxpayer and you're in the 37% bracket, the most that your itemized deductions can save you, or that you can get a benefit for, is up to 35%. So an extra 2% haircut for some folks. And just in case you were curious, but the 37% bracket for a single individual starts at 626,350. And then for a married couple, it's 751,600. So we're talking really high income earners, but they're the ones that are going to see this additional limitation. And I think this is really best explained with an example. And so we've got a charitable contribution example here. And in this example, we assume that someone is going to make a $100,000 charitable gift in the current year, and that their income is high enough that they are in the 37% bracket. So on the left side, the TCJA, that's our current tax law. So we're going to look at the scenario there and then look at the scenario under OBBBA. So if we look at the left side under the Tax Cuts and Jobs Act, so we have our AGI, which is our income. We're going to assume that's $1 million. And then we're going to have a charitable contribution of 100,000. So we subtract those two numbers, and our taxable income is 900,000. And our tax savings on that $100,000 charitable contribution is $37,000. So really nice tax savings. So now we move over to the right-hand side, and under OBBA, we have that same $1 million AGI, and but now instead of a $100,000 charitable contribution, you can see that we only have $95,000 charitable contribution. And that's because of that 0.5% haircut that we were discussing. And we get there by taking our $1 million AGI times 0.5%, and that's $5,000. And so that first $5,000 of our charitable contributions doesn't count. It gets carried forward. And so for the current year, we're left with 95,000 of a charitable contribution, leaving us with $905,000 of taxable income. And then it gets even better, right? We have the tax savings instead of at 37%. Now we have that limitation where we can only go up to 35%. So our tax savings on that $95,000 charitable contribution that we get to do is $33,250, or a difference of $3,750. And then when we add on that, you notice we have taxable income of $900,000 on the left, $905,000 on the right. So we've got $5,000 more income that we have to pay tax on, which is going to equate to $1,850 in more tax. So the total difference between what the current law is and what it's going to be under OBBA is going to be a difference in tax savings for that person of $5,600. So, I mean, if we're making $1 million, $5,000 isn't a huge portion of that, but it's still a significant amount of money. So just wanted to kind of share with an example how these new limitations are going to be in place starting in 2026, just to give you an idea of what's going to affect you and your donors, right? So might be yeah, just want to lay the groundwork so that you're aware of how the numbers work. All right, so kind of a summary slide here, but overall, 2025 is going to be better than 2026 for those charitable contributions because of that 0.5% haircut and that cap on itemized deductions. So now moving on, want to just kind of step back. We're going to talk about these two changes to the charitable contributions again, but at a little bit higher of a level. So starting out with this concept of the expanded universal charitable deduction. This is one of the bill's most high profile nonprofit related provisions, and again begins in 2026. And so all taxpayers, even those who don't itemize, can deduct up to $1,000 for an individual or a single filer, or $2,000 for a married couple. So this change is expected to encourage new and modest donors to support local nonprofits, or doesn't have to be just local, but national nonprofits. It's expected to generate an estimated $74 billion in additional giving over the next decade. And it's one of those things that folks on both sides of the aisles were in favor in. So I got into the bill, and it was a way that they could boost charitable giving to those organizations, and especially those local communities or local community organizations that are really reliant on those broad donors. And so what are the implications for nonprofits? Well, I think the biggest thing is, like, every dollar counts, and now it's deductible, right? We've got this $1,000 or $2,000 that even modest donors can now get a tax benefit for, where in the current law, they're not getting a benefit for those. So people are going to have to start saving their receipts again and providing those when they're getting their taxes done. But I think it's really going to encourage those modest donors that believe in an organization, believe in your organizations, and are not necessarily even doing it for the tax benefit, but they're doing it to feel good about it. But you'll be able to kind of use your communications to say, like, hey, now you can feel good about it and you can get a tax benefit. Because most people don't want to pay any more taxes than they have to. So this can be a way really to message it out to your donor bases, and encourage people to donate as much as they can. So our recommendations here is really just educating the public through donor newsletters and social media. And then partnering with local CPA firms and organizations in your area to do things like we're doing today, right? Educate people and get the word out. And then also just plan your communications around kind of the tax season, right? Where a lot of these changes are going to be happening. In 2025, we've still got um, we don't have those extra limitations on charitable, so you can really play into like, hey, get your charitable contributions in before the end of the year. Then also in 2026, right, we now have that new universal charitable deduction, so can also play on that piece of it as well. So this is the big win, I would say, in the new tax law is that expanded universal charitable deduction. So then, as Kirsten mentioned, right, there's some positives and some negatives. So then we switch over to some of the negatives. And so these floors or caps, these are really going to threaten a little bit of those larger donations, right? Because now they're going to get less of a tax savings for those dollars that they're donating. So again, that floor is 0.5%. It's going to go into place next year, and that's just for individuals. The other thing we haven't mentioned yet is that there's a 1% floor for corporations, meaning that only those donations that are over 1% of that corporation's income are going to be able to be deducted. And so that really could change how corporations view charitable giving. And we don't know what the impact is going to be, but that could be significant on your organizations. And then on top of that 0.5% haircut that they've put into place, right, we also have that cap at 35% of itemized deductions instead of being able to go along with whatever tax bracket you're in and those high net worth individuals that are in the 37% tax bracket and being able to make a charitable donation and get that 37% tax savings. Now it's going to be limited to 35%. So the Council on Foundations and other philanthropic advocates, they warned that this could actually reduce high net worth giving by over $80 billion, with private foundations and major institutional funders being most affected. Right, so this could be a significant impact to your organizations. We'll see how it plays out, but just want to kind of let you know what are the positives and what are the negatives that are going on. And so implications for the nonprofits. So again, just going to impact kind of how people are looking at charitable giving on that larger scale. We'll see if that changes what people are going to give. And then we've also got new education related tax credits that might risk donor diversion away from the general causes and to focus on more specific causes. So we'll see what happens here, but our recommendations are work with financial advisors and wealth managers to preserve that donor's intent, right? Those are the professionals, along with the tax folks, that are intimately talking with donors about what they want their legacy to be, right? We often say we don't let the tax tail wag the dog. And I think that applies here as well, where if a donor has charitable intentions, they're going to do it no matter what. And so we really want to just continue to make sure that those conversations are happening and that we're encouraging people that have that charitable intent to continue to do that. Also want to focus on multi-year pledges, right? Just to have that consistency and that income that we know is coming in year after year. And then also considering pooled giving vehicles through organizations such as community foundations. So that is a lot of information for you today. Hopefully you can take away a few nuggets. You'll get the slides after the presentation, but now I'm going to turn it back over to Kirsten to talk about the scholarship tax credit.
All right, thanks, Holly. So I've got a few things to go through that are specific to the nonprofit sector. So we're going to cover the scholarship tax credit, excise tax on salaries at $1 million, federal spending cuts, legal and political risk, and then also federal funding freezes. So we'll work through that. So with that, for the scholarships, so HR 1, which is the one big beautiful bill, there is a federal tax credit for donations to scholarship granting organizations, also called SGOs. So when I say SGO, that's what I'm talking about. The tax credit is tied to kindergarten through 12th grade scholarships, and every state has to opt in individually by January 1st, 2027 for its residents to benefit. So with that, there's new funding opportunities for those education-focused nonprofit organizations where there's potential to expand scholarship programs, increasing student access, and strengthening relationships with families and communities. Also, organizations may need to navigate eligibility reporting and compliance requirements in connection with scholarship granting organizations. So there's kind of two pieces to this. There's the scholarship granting organizations and the nonprofit that focuses on education. And then aligning with these SGOs might require partnership agreements, administrative costs, and capacity and governance oversight. So one thing next that talk about as far as implications for nonprofits goes, so education-focused nonprofits and foundations could see new resources by organizing or partnering with these SGOs as donations come in, so individuals take advantage of that tax credit. But the risk with this is that this credit encourages giving to an education-focused nonprofit that's going to participate in the SGO process, where taking dollars away from every other nonprofit organization. So that's an issue there. It could create competitive pressures and other issues, unintended consequences through this process. Recommendation-wise, we're looking at different options between those nonprofits that focus on education, and then those are then the rest of the nonprofits that focus on lots of other great things. So educational focused nonprofits wanting to participate in this and being able to accept contributions under this program should advocate for their state to opt in first, if that is not more of an automatic, and then prepare to align themselves. They should look at developing targeted fundraising campaigns, making sure their donors are aware of this tax credit, and communicating the direct impact of these scholarships on students to their donors, emphasizing what results could happen from that. So, could more students participate? Could they, get different opportunities for education that they wouldn't have, that kind of thing. On the other side, other nonprofit organizations should do what they always should be doing, which is exploring other opportunities to keep their donor base secure, but also highlight their unique community impact, what they do, why it's so important you donate to them. They could also work in conjunction with other education nonprofits and work together in some way collaboratively, but should continue doing what they always do and think of recurring giving programs and programs, fundraising programs, definitely highlighting their activities and how important each nonprofit is to its community. So kind of thing we always know as nonprofit organizations, always staying on top of messaging and things like that. Next in this presentation is excise tax on nonprofit executive compensation. So for most likely a lot of our Madison participants or our Wisconsin participants, there may not be a lot of you who are dealing with salaries this high. I know we have participants from other states and maybe this affects you, but we wanted to make sure we bring it up because it is a new part of the HR 1. So it reintroduces and expands a 21% excise tax on nonprofit executive compensation. So it doesn't just apply just to the executive, it also expands to the top 5 earners. So it'd be the executive director, and if there's 4 more people making $1 million or more in compensation. That excise tax is paid by the nonprofit organization. So for those that are very large and have this level of salary, it could be a significant cost to them. The Act also reinstates taxation of certain employee benefits like parking and transit, which that has been taxable, the non-taxable, to the employee. So this is an employee tax on that type of benefit that's given. So the bill itself targets tax-exempt entities, including hospitals, universities, and large foundations. So with that, that's typically where you see like the larger salaries come into play. And for those entities that'll have, sorry, losing my spot here, those entities that would have this kind of thing happen, it could be a significant cost to each organization. And other impacts on nonprofits as we look at this, like I said, it could impact executive comp at large institutions such as hospitals, universities, foundations, or even big national organizations where they head up over, all of the smaller ones by the states. But it could also lead to more donor scrutiny of compensation, even in mid-sized organizations. And so that's something to keep in mind if you're dealing with this, or even if you're not at that level, just that kind of awareness and focus in on comp for nonprofit executives could end up infecting the entire sector. Recommendations wise, we're looking at first your board, reviewing compensation policies, deferred compensation, and benefit packages. Also looking at compensation, even from like an audit perspective, looking at comparing salaries and benefits to industry and regional benchmarks, which is what nonprofit organizations should be doing anyway, regardless of the dollar amount. You should have in process how you're determining comp, what resources you use to get to that level, whether it's, things, for example, through GuideStar, or what you're doing to determine what's an appropriate compensation for your executive director and other executives in the organization. So keep that in mind too. It's no different than in the past. You're just dealing with a larger dollar amount. But like I said, you could have a lot more donor scrutiny with comp in general. So it's always good to be prepared with your methodology of how you came to certain amounts and what the board did with that. Also, they do recommend documenting in the board minutes, but those can be public documents. So you could always do that as like an executive compensation meeting and keeping those minutes secure. And then also keeping the board educated about these types of things that can impact the organization. And then if there are compensation policies in place, making sure they're following any regulations in connection with compensation. One thing too is monitoring IRS guidance. And I'm sure you're all saying, why would I do that when we have you? But, and that is true, but keeping an eye on changes with that guidance. What happens when there's new tax laws? It can be very vague. It can not really address questions that naturally come up. So over time, the IRS will issue clarification and more information. And definitely that's something that we keep on top of. So you can certainly contact us, contact your provider, whatever works. But things do change over time and more clarification is provided. So I would expect that would happen over time. With your donors, as this becomes more of a thing in the sense of it brings more awareness to nonprofit executive compensation, you want to be ready to be able to communicate transparently with the donors and other people in the public that might have questions and interests. And that's why that documentation process, how you came about the numbers of comp, regardless of what it is so important, so that you're ready to be able to have a conversation and not caught flat-footed and not ready to do that kind of discussion. And then one thing too is to watch for possible similar legislation at each state level. So states could adopt that same excise tax percentage, and so you're basically doubling. So that's something to consider as time goes on. Right now, that's not happening, but definitely something to consider. For Wisconsin nonprofits that are on the webinar, you'd be looking at the Wisconsin Department of Revenue, and same with revenue entities in the other states that are also on the webinar. So with that, like I said, may or may not apply, but everything around comp is always really important to document how you got there. What sources did you use to determine executive compensation? So now we're on to federal spending cuts and shifting the burden to nonprofit organizations. So what that means, as we all know, if you have federal funding and are experiencing cuts, you will, as the organization, have to come up with the difference or change what you're doing. So with that, we know there are major cuts to public safety net programs. So Medicaid and instituting work requirements and funding restrictions, reductions in SNAP, which is food stamps, public housing assistance, and other core social programs. That could expand to many more. We don't know at this time. There is a ban on Medicaid CHIP coverage for gender-affirming care starting in 2027, removing these procedures from the Affordable Care Act as essential health benefits. So things to consider. So what you can do in this situation is really look at your core services, and if you can prioritize maybe certain services are the real core of the organization, and that's where your dollars are going to go for now. If you do experience federal spending cuts, or you're looking at maybe eliminating a program or whatever you need to do to make sure you're still serving the maximum number of your constituents, and then also dealing with any cuts that you might experience. So let's go to the implications of this part of the Tax Act. So we will, and we've already seen with some of our clients, increased demand for food, housing, medical care, mental health support, and case management. That list could be a lot longer as far as things that could be in crisis or threatened. Reduce funding for contract and grant supported services. And then also higher demand on LGBTQ plus nonprofits to fill coverage gaps for gender affirming care. So these are just some of the implications, and I think unintended consequences and that kind of thing, just my opinion. But there are a lot of things that could happen in the course of this. Things to consider when you're in this part. These are part recommendations, but just look at staggering your program spending, reassessing capacity and your budgets, building or expanding your reserves, diversifying your revenue streams, which is always important. I've been working with nonprofits for almost 25 years, no, more than 25 years, almost 30 years. And diversifying revenue streams is always important. Always good to have multiple sources of funding coming in. Educating your donors on cuts and what it means to the organization so that they can respond in kind if they have that interest and help you. And also while highlighting your most urgent needs. So if a donor was to say to you, where do you need the money most? That's what I want to give. Then you're ready to have that conversation. And then, as Holly mentioned, leveraging the expanded charitable deduction. And then also looking at collaborations with other entities and launching targeted fundraising campaigns so that you are able to help out and fill the gaps on your own. So with that, we'll look at legal and political risks next. So these are not codified into the tax law in the statute, but they are a result of concurrent executive actions. So nonprofits engaged in diversity, equity, inclusion, DEI programming, which honestly, who isn't? So that could be a wide swath of nonprofit organizations. Organizations advocating for immigrant rights, reproductive health, LGBTQ plus rights or environmental policy, and media and journalists. So looking at that, what are the impacts on legal and political risks? There are many. It's not just two, I can tell you that, but there will be greater audit risk or reduced federal support for advocacy-oriented organizations. We will learn more as time goes on. This is the area of the presentation where there's a lot of ambiguity, and we'll see what happens as time goes on and different things happen within the country. Some of your foundations may pause or reconsider grants tied to controversial programming, quote unquote. There may be grant making uncertainty or reputation or operational risks depending on what you're doing, and things you need to be aware of is making sure that you're in compliance with everything. On recommendations under this category, there are many, but for those of you who are doing lobbying, reviewing 501c3 lobbying and advocacy guidelines with your legal counsel, documenting what you're doing, and also educating the public about what you're doing and making sure that your advocacy and policy initiatives are demonstrating nonpartisan intent and compliance, because you want to make sure you can keep doing what you do as far as an organization, and training your staff and board members on permissible activities and risk management. As always, document all the things that you're doing very carefully. That is the key to show that, no, this is our intent, this is what we're doing, this is how we're helping the community. So it's very clear in trying to limit any legal action or some kind of retaliation or something like that may or may not occur. It's also important to collaborate and educate your donors, but collaborate with other organizations where you could share resources, and then educate your donors about the nonpartisan nature of your work so they'll have a comfort level as far as donations and things like that. And also just, again, with all of this, document transparency, be prepared to have conversations about areas you may not have had to have those in the past where you may now because of this increased scrutiny, easy for me to say. This section could go on and on and on. There's a lot of uncertainty here, but we're going to, in the interest of time, move on. So with that, we're going to look at federal funding freezes. So we have add short-term turbulence. It could be long-term turbulence. So in January 2025, the Office of Management and Budget sought to freeze all federal grants to NGOs. And so what that means is those are organizations that are called nonprofit entities independent of governmental influence, although they might receive government funding. The policy was tied to new vetting standards. The courts struck down most provisions, but it highlights the instability between federal grant making and the reliance of nonprofit organizations. So the implications to our nonprofit organizations are obvious. We have had a couple clients that have already experienced this, where things were frozen, but then unfrozen. So that was very helpful for them. But I would say expect delays of, if you're in a cost reimbursement contract situation, of getting your funding, or just even grants, getting approval, things like that. You could have cash flow strain. You could have service interruptions. There could be additional compliance involved. So you demonstrate that you're spending the dollars in an even more transparent way than what we do now for the allowable costs that are included. Recommendation-wise, again, diversify your revenue, strengthen your cash reserve and access to credit lines. Now more than ever, you need to make sure you've got other sources of money coming in. You've got reserves so that you can survive any delays or stoppages and things like that. And look to the community or donors or fiscal sponsors if there's a gap, that they can help you out with in a short term, even looking at lines of credits, things like that. So the federal grant freezes and program cuts do shift costs and responsibilities to the nonprofit organizations. So they transfer the burden, which will be, I know, a lot and be very difficult for many organizations coming up as time goes on. And it destabilizes you as you're trying to provide services for vulnerable populations. So this is an area that do a lot of deep thinking and conversations about how you can fill gaps and be proactive. Maybe nothing happens and everything's fine. But then you've done all this proactive work, which is also great. So keep that in mind. As you can see, there's a common theme about diversifying revenue streams, building reserves, being transparent, documentation. That's the main things I'll say on that. With that as a summary in this section, it's a new landscape for nonprofit organizations, including a mixed bag, some positive, some what we would say is a little bit more negative, and some that's a little more ambiguous. So in this case, charitable deduction that Holly covered, there's an expansion for small donors called the universal deduction. In major giving, more of a negative, AGI floors, caps discouraging large contributions and risk of donor diversion. Education funding, the tax credit for SGOs can be great, but you've got to offset that with those of you not working in that space, making sure you're still communicating with your donors and keeping your funding levels secure as well. And then executive pay, again, this may not apply to a lot of you, but knowing that excise tax exists and how important it is at any nonprofit to document how you came up with compensation for those leaders in your organizations. And then government grants, contracts, and I'll also include here federal funding freezes, the cuts we talked about, the delays in federal funding, that kind of thing. And then finally, legal and advocacy risks, uncertainty for DEI, reproductive rights, LGBTQ plus nonprofits, and many others. That list could be much longer. But I see Lee is back on, so I will turn it over to him and we'll go into questions.
Yeah, all right. Well, Kirsten and Holly, you guys are going to have to take a little rest, and that was a lot of ground to cover. There was a lot. We've had a couple of specific questions come in that I want to make sure get addressed. and then a couple of other broader ones that I think we should hopefully have time for as well. So let's try and keep these answers brief, but I know we've gotten this question a few different ways from even previously as well. And one of the questions is about the 0.5% floor or the 1% floor for corporations. So there's been some confusion around, does that mean, let's say, just to keep numbers nice and easy, for a corporation that donates 1% of its profits, that it can then deduct everything, or it's only what is above the 1%?
So great question, Lee. And so you would only be able to deduct what is above the 1%. So that 1% is a floor, and that first 1% would not qualify for a deduction.
Right. Okay. And I think that there was some confusion around that when this first passed, that this was an encouragement to try and get people up a little bit, but really this is something that's going to, I think you mentioned, what was it, maybe decrease overall giving by, what was it, 80 billion, I think you said?
Yes.
Yeah, that's a big number. Okay, we will come back to that in a second, but another specific question we had was for the scholarship tax credits, would contributions that schools might use to provide scholarships for after-school programming qualify, or is it just tuition-based scholarships?
Oh, that I don't know. I don't know the details on that. And I have not found anything that details that out either. So I don't have an answer for that, but depending on if we know who this person is, I can answer it later. I honestly did not find anything that details to that level. This could be something, it doesn't go into effect till 2027, so could be where it's not worked out yet.
Yeah, and Holly, actually, that we didn't have a question about this, but I know we've talked about it before. Some of this stuff it's written in a bill, but that doesn't necessarily mean that this is how the IRS is going to view it. Do we have a sense of when some of these pronouncements are going to be coming out so we get final answers on some of this stuff?
Yeah, it's always it depends, right? I mean, we didn't expect the tax law to actually pass July 4th, right? We were expecting that it probably wouldn't happen until January. So it was so they surprised us that they got it passed so quickly, which in some ways is great because now we had 6 months to try to figure out what the impacts are, and we're still discovering new things all the time, just as more information is available and right, our tax programs are being updated for these different uh, limitations and changes so that we can actually model what the true impact is.
Right. Okay. So getting back to the sort of 0.5% floor, do we have a sense of how that universal charitable deduction interacts with the 0.5% floor? Like, so does that go towards
Sure.
how does that work?
Yeah, so they're essentially two different things. So you're going to be subject to one set of rules if you are taking the standard deduction. And that's if you're taking the standard deduction, you're going to have that $1,000 or $2,000 deduction that's available on top of your standard deduction, no 0.5% haircut there. But if you itemize on the other side, then you're going to be subject to that 0.5% haircut. So first part is going to depend, am I taking the standard deduction or am I itemizing? And then you find out if you get that 0.5% haircut or not.
Okay, gotcha. I guess just maybe some thoughts on how you think this is going to shift giving patterns, like especially on the corporate side. I mean, we've got a lot of people on here who get a lot of their income comes from corporate donations. Like, are we thinking this is going to be a situation where corporations move more towards that bunching their gifts? Is that where you see this going? Kirsten, I guess I'll hand this one to you.
Yeah, so from what I've read, there is the hope and there is a lot of talk about private organizations, foundations, community foundation, other sources jumping in to fill the gap as well as they can, where it really shifts to the private sector, whether it's at the corporate level, foundation level, state and local governments, or if it's individuals. And, for those of you working in the Madison area, you know that we're a very philanthropic community, and I could see that happening. But I also see at a certain point that dollar amount could be insurmountable, depending. That's the thing about this. There's so much that we don't know. We don't know what will happen. But that is what I've read in many sources, that is the hope and a little bit of expectation that everybody else will kind of jump in to fill the gap.
Great.
But as far as the tax side, that's just the altruistic philanthropic side, not the tax side of that.
Right. So much more there, really. So Kirsten and Holly, thank you both so much. We are at time, so I want to be respectful of everybody's time. And just, you guys have gotten some great comments in the chat here. So thank you for what you do, and thanks for all the time you put into presenting this and preparing for it, because I know our audience and our clients really appreciate it. I just want to remind everybody as we wrap up that you can go to sva.com/OBBBA, 3Bs, to see information like our biz tips, upcoming webinars we might have scheduled. I mentioned the podcast, the Biz Beat by SVA earlier. That is going to be really more towards any taxpayer, nonprofit, business, you name it, that's more general in nature, but we've got lots of nonprofit information up there as well. And, just a reminder, this webinar really was designed to just be a general overview of how this could affect you and your donors. But, your organizations, obviously your donors are unique. And so lots of other factors can come into play. And all that to say, you really need to have a strong advisor to help you navigate everything that's going on right now, help you and your organization. And, obviously, guess what? That's where SVA comes in. So if you don't have a strong CPA partner at the moment, whether that's for your audit or helping out with just daily accounting, now's the time. We are only a phone call away. So if you on this call are already a client of ours, please reach out to your SVA professional if you have questions. If not, please contact me or certainly Kirsten or Holly, and we can get you the help or the answers that you need. One other big thing, I got the breaking news update since we started. Travis Kelce and oh, now I'm going to forget her name.
Taylor Swift.
And Taylor Swift are engaged, everybody. So big news to share. Thank you all. Glad I could deliver that important news. Thank you all for attending today. We hope you have a great rest of your afternoon. Bye-bye.
Thanks.